watching Ask the Institute, presented by the Options Institute at CBOE.
Welcome to Ask the Institute, where we explore the topics that you want to know about. I'm Michelle Kaufman, Market Observer at the Options Institute, the Education Division of the Chicago Board Options Exchange. Today, I'm here with resident VIX expert Russell Rhoads, instructor at the Options Institute at CBOE. Welcome.
Thanks for having me.
Absolutely. Russell is here today to talk about the VIX index and to discuss a common question that we receive in the Ask the Institute inbox, which is, Russell, why does the VIX index and the S&P 500 index generally move in opposite directions?
Well, before diving into exactly why they move in opposite directions, I'd like to talk about what the VIX index is.
Sure.
Okay. Well, the VIX index is the CBOE Volatility Index, which is a 30-day measure of implied volatility as indicated by the S&P 500 index option marketplace.
Can you go on to further explain for us how the VIX is calculated?
Sure. We take the next two standard option expiration series that are trading in the S&P 500 index option arena that have at least 8 days left until expiration. We take all the at-the-money and out-of-the-money put and call options, take the midpoint of the bid-ask spread on all of those option contracts, throw them into a formula, and develop a synthetic at-the-money index option contract that expires 30 days from this very second. The implied volatility of that option contract, that synthetic option contract, is what you see is quoted as the VIX.
Thank you. Now, can you explain that for us in layman's terms for our viewers?
The VIX is the market's expectation of volatility for the S&P 500 over the next 30 days.
Okay, thank you. Let's go back again to our original question, which was, why does the VIX index and the S&P 500 index generally move in opposite directions?
Well, when there's excess demand or excess buying by the public of option contracts, like when the market is under pressure and we see excess demand for put options, that generally pushes the implied volatility of all S&P 500 index option contracts higher. The implied volatility of S&P 500 index option contracts is what we see quoted as the VIX. Excess demand comes when there's a little bit more panic in the marketplace.
Okay, but what about when the market rallies? Why does the VIX then tend to go downward in those instances?
Well, this is based in behavioral finance. Generally, people are a little bit more panicked to buy when the market is under pressure as opposed to buying call contracts when the market starts to rally. You don't generally rush into the market to buy call contracts because you're not looking for protection against some sort of downfall.
Can you correlate that to how the VIX index is sometimes termed the fear and greed index?
Well, generally in the media you'll see the VIX referred to as the fear and greed index at times, and that's because it tends to move higher when the market's under pressure and there's fear in the marketplace, and tends to go down when the market's moving higher, and I guess that's the greed side of that.
Russell, thank you for joining me today on the show.
I appreciate you having me.
Absolutely. Now, if you'd like to learn more about VIX options and futures, you'll want to join Russell Rhoads on Saturday, May 7th. Russell will be here at the Chicago Board Options Exchange for an all-day seminar on how to trade VIX. Visit www.cboe.com/seminars for more information or to register to attend here at the CBOE or live virtually online. This is Michelle Kaufman, Market Observer at the Options Institute, exploring the topics that you want to know about.